Picture this, it's 1976, just after a bruising bear market. The Dow's been bleeding and hope feels thin. Yet Richard Love is staring at a curious pattern. Every 4 years, stocks don't just bounce back, they explode. But which ones? Why? And how do you spot the superperformance rockets before they ignite and triple your money in a flash? That's the puzzle Love dives into, unlocking a wild political cycle secret that still echoes today. Love's first big idea? Your calendar isn't just for dates, it's for dollars. The U.S. political cycle isn't a boring loop, it's a secret stock market pulse that beats every 4 years. Back in 1972, before Nixon's re-election, key stocks started ramping up. Love noticed this wasn't random. Fiscal stimulus and Fed rate cuts before elections create a fertile runway for certain stocks to soar right as voters cast ballots. Think of the economy like a weightlifter prepping for a big lift. Monetary easing drops interest rates, fiscal policy pumps in stimulus cash. This prep sets the stage for stocks to jump higher, lifting the whole market and prime candidates into superperformance chutes. When the market tanks hard, like in '74, it's not just pain, it's a reset. Love swears these bear markets clear the decks, exposing undervalued stocks with real growth stories, like hidden gems ready to shine once the cycle turns upbeat again. So what exactly makes a stock a superperformance rocket? It's not just luck or hype. It's about surprising earnings, bold moves, and sharp pivots that catch the market off guard. Love's definition of a superperformance stock: one that triples in price within 2 years, no slower. For example, consider a company that surprises Wall Street with a 50% earnings jump, pushing its share price through the roof before the market even fully realizes the impact. Imagine the stock market as a jury. It discounts everything today but believes in tomorrow. When earnings leap higher than expected, it's like a surprise witness showing up, triggering a frenzy that sends that stock into hyperdrive well ahead of profits hitting the report. Companies like Alcoa during this era exemplified how fresh leadership and breakthrough products trigger growth. When a new CEO pivots successfully or launches a killer product, investors see this as a sneak peek of higher future earnings, transforming expectations and share prices. Now the kicker, when to strike. Love reveals superperformance stocks shine brightest in the ashes of market crashes, but timing and environment rules apply. After the 1970-370 for bear market, many solid companies were trading dirt cheap. Love's insight? That's prime hunting ground. These dips aren't traps but opportunities, where patient investors spot tomorrow's winners before everyone else. Low interest rates are like gasoline on a fire for stocks. When the Fed cuts rates and governments ramp spending, the cost of borrowing drops, liquidity rises, and suddenly companies with strong earnings surprises get a turbo boost in price. The market loves promise but hates disappointment. Sometimes stocks skyrocket on hopes of mergers or product breakthroughs, but if those don't materialize, prices crash hard. Love warns, only those betting on genuine earnings power survive these swings and become true superperformance champions. Remember that gloomy 1976 market from the start? It wasn't just despair, it was the quiet before the storm of superperformance. Richard Love teaches you to see beyond the chaos, spotting political rhythms, earnings shocks, and perfect timing after corrections. So next time markets wobble, try this. Check the political calendar, hunt earnings surprises, and buy into bargains timed with easing policies. Your future portfolio might thank you. Subscribe for more book summaries like this one.